Today's video explains the IFSC Anti-Money Laundering, Counter-Terrorist Financing, and Know Your Customer Guidelines 2022, updated up to 2nd January 2026. We'll cover applicability, risk-based approach, customer due diligence, monitoring, reporting, and sanctions compliance. These guidelines establish how regulated entities in IFSC must prevent money laundering and terrorist financing. The core expectation is identify risk early, verify customers properly, monitor continuously, and report suspicious activity. The guidelines broadly apply to every regulated entity licensed, recognized, registered, or authorized by IFSCA, and also apply to a financial group of the regulated entity to the extent specified. Certain entities or activities can be exempted, but exemptions do not mean no AML thinking. Where required, entities should still conduct and document business risk assessment. And if risks emerge, AML obligations continue under applicable law and the framework. Every regulated entity must have an AML-CFT policy approved by its governing body, with KYC policy as part of it. Senior management is responsible for compliance and must exercise due skill, care, and diligence. The foundation is the risk-based approach. Regulated entities must identify and assess ML-TF risks based on customers, geographies, products, services, transactions, and delivery channels, then apply proportionate controls. Risk assessment should be documented and reviewed at least every 2 years or earlier if a trigger event occurs. Business risk assessment means understanding your enterprise-wide exposure, who you serve, where risks come from, how products and channels could be misused, and how transaction patterns may elevate risk. New products, new delivery mechanisms, and new technologies require risk assessment before launch. Customer risk assessment must be completed before customer due diligence for new customers. It considers beneficial ownership, purpose and intended nature of relationship, customer business profile, ownership control structure, geography, products or services, and transaction expectations. The output is a risk rating, low, medium, or high. A regulated entity should not establish relationships where beneficial owners cannot be identified, where accounts are anonymous or in fictitious names, or where the customer is a shell financial institution. CDD has 4 pillars. Verify the customer. Verify beneficial ownership, understand the purpose and intended nature of the business relationship, and perform ongoing due diligence, ensuring transactions match the customer's profile and risk rating. For individuals, collect name, unique ID, date of birth, nationality, domicile, residential address, and contact details. For entities and arrangements, collect identification numbers, incorporation details, business addresses, and understand the legal form, constitution, control structure, plus connected parties. Beneficial ownership identification is critical. The regulated entity must take reasonable measures to verify who ultimately owns or controls the customer through ownership or other means of control. For trusts, identification includes author, trustee, beneficiaries with specified interest, and any person exercising ultimate effective control. For high-risk customers, enhanced due diligence applies. Obtain more information, examine ownership and financial position, verify source of wealth and source of funds, obtain senior management approval, and increase monitoring intensity. High-risk geographies called out by FATF require proportionate EDD. If risk is low, simplified CDD may be applied, like reduced update frequency or reduced monitoring intensity. But simplified CDD must never be used when ML-TF suspicion exists. Ongoing due diligence requires scrutinizing transactions for unusual patterns, making inquiries, documenting findings, keeping CDD current, and conducting sanctions screening, especially against relevant UN Security Council sanctions lists and other applicable lists. Suspicious transaction identification typically follows. Detect red flags, ask questions without tipping off, review records and customer profile, evaluate whether reasonable grounds exist, and then file a suspicious transaction report to FIUN promptly once suspicion is concluded. Regulated entities must maintain strong internal controls. Appoint a sufficiently senior principal officer with resources and access, ensure independent audit of AML-CFT controls, and provide periodic training so staff can recognize suspicious behavior and understand reporting obligations. To implement this framework effectively, start with governance, document business and customer risk assessments, ensure robust CDD and beneficial ownership checks, monitor continuously, screen sanctions, and maintain strong STR processes without tipping off. This is how compliance becomes operational and defensible. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BATF, and ancillary regulations. And FinTech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.